Hi everybody. This is lecture for topic 11, ACT3113, executive. So I'm trying to finish all the lectures, to do all the lectures this week, so that next week you can have time to prepare for the final exam. So this topic supposed to be lecture for topic number 11, statement of cash flows. Okay, a statement of cash flows actually shows the cash in and cash out that happen in a business. In a financial statement, in a financial statement there are five main components. The first one is income statement. The second one is the balance sheet, and then statement of equity, and then statement of cash flow. The income statement and balance sheet and statement of equity are prepared using accrual basis. So to show a complete picture about a business to the financial statement user, then I will explain it in another way. So the income statement, balance sheet and statement of equity are prepared using accrual basis. And then this is the fourth component in the financial statement, the statement of cash flow. It is prepared using cash basis. So this fourth statement shows the whole picture about a company or a business to the financial statement users. So when the user can get a complete picture about the business by looking at this fourth statement. If we skip the cash flow statement, then it is not a complete picture because it shows only the accrual basis accounting. When you include the cash flow statement, it shows the cash in and cash out. So hopefully the financial statement users can see a complete picture about a company. So that's why cash flow statement is important. So it is an important document in the financial statement. So these are the four the steps that you have to do when you want to prepare a cash flow statement. So the first thing that you have to do is calculate the increase or decrease in cash, and then calculate net cash in operating activities, and then calculate the net cash from investing activities, and then calculate net cash from financing activities. And then the last step to do when you prepare the cash flow statement is reconcile between the operating and the closing balance of cash. Okay, I will show you the format of the cash flow statement later in this lecture. Okay, so you have to know that a business or a company uses cash for three main purposes. The first one is the company will use cash for a company will use cash to do operating activities. And then the second thing is a company will use cash to do investing activities. And number three is a company will use cash to do financing activities. Okay, let's see the operating activities first. Operating activities refer to the main business activities of an entity. Operating activities represent the main business activities and principal revenue producing activities. Thus, this group should be the main concern of the entity, and other users of financial statements that have an interest in the entity. Consequently, the activities under this classification will feature the determination of the profit and loss of the entity. So operating activities means the activity of the company to generate a revenue. So most of these activities can be seen in the income statement or statement of profit and loss. Okay, let's see the next slide. Okay, these are examples of cash flows from operating activities. The first one is cash receipts from the sale of goods and the rendering of services. The second one is cash receipts from royalties, fees, commissions, and other revenue. C. Cash payments to suppliers for goods and services. D. Cash payments to and on behalf of employees. So there are other examples. Cash receipts and cash payments of an insurance entity for premiums and claims, annuities and other policy benefits. Cash payments or refunds of income taxes unless they can be specifically identified with financing and investing activities. And cash receipts and payments from contracts held for dealing or trading purposes. This is according to MFRS 107. So like I said earlier, most of the operating activities can be seen in the income statement. The income statement shows things related to the main activities, revenue generating activities of a business. So okay, this like I said earlier, the second way that a company will use their cash is for the investing activities. So let's see. An extent to which expenditures have been made for resources with the intention to generate future income and cash flows. In terms of economics, investing activities can be understood as accumulation of physical entities such as factories, machines, and plants to generate benefits. In terms of finance, investing activities can be seen as putting money in an asset in the hope of gaining profits from capital appreciation, dividends, and interest. So investing. So remember, investing activities means the activities done by a company to generate future revenue. So sometimes they purchase fixed asset, a machine, building, factory, etc. to generate future revenue. That is one way. Another way is they purchase something like bond, shares in other companies, keep cash in fixed deposit, etc. Also with the intention to get future return. So this kind of activities are called investing activities. So let's see, there are examples here. Okay, the first example is cash payment to acquire property, plant and equipment, intangibles, and other long-term assets. So this is an example of cash transaction related to investing activities. And the next thing is cash receipts from sales of property, plant and equipment, intangibles and other long-term assets. Cash payment to acquire equity or debt instruments of other entities and interests in joint ventures. D. Cash receipts from sales of equity or debt instruments of other entities and interest in joint ventures. E. Cash advances and loans made to other parties. When a company giving loan to another party, then the company can get return in term of interest, in the form of interest. Okay, the next example is cash receipts from the repayment of advances and loans made to other parties. The next thing is cash payment for future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes, or the payments are classified as financing activities. And cash receipts from future contract, forward contract, option contract, and swap contracts, except when the contracts are held for dealing or trading purposes, or the receipts are classified as financing activities. This is according to MFRS 107.16. So we can see that the cash transaction related to investing activities can be seen in the balance sheet of of a company, because these activities can affect the assets and liabilities. Can affect the assets. Okay, so cash also is used by a company to do financing activities. Financing activities activities that result in changes in the size and composition of the equity and borrowings of an entity. So most of the time, activities related to financing can be seen in the balance sheet, specifically in the section of liabilities and equity, because these activities are related to the composition of equity and borrowings of an entity. So the examples of financing activities are cash proceeds from issuing shares or other equity instruments. Second, the B is cash payment to owners to acquire or redeem the entity's shares. C, cash proceeds from issuing debentures, loan notes, bonds, mortgages, and other short-term or long-term borrowings. D, cash repayments of amount borrowed. And E, cash payments made by a lessee for the reduction of the outstanding liability relating to a finance lease. Okay, there are two methods in preparing the statement of cash flow, or in another way we can say that there are two formats for cash flow statement. The first format is called direct method. Direct method is when you prepare a statement of cash flow using direct method. This method separates major items of operating cash receipts and major items of operating cash payments, where the latter will be subtracted from the former. Consequently, it adjusts items in the statement of profit or loss and other comprehensive income from the accrual basis to cash basis. Okay, direct method is a cash flow statement format that is basically convert the income statement of a company from the accrual basis to the cash basis. Remember, I have told you most operating activities can be seen in the income statement. So you can convert the income statement from the accrual basis to become cash basis, and then you use that to prepare the statement of cash flow. Another method or format of doing or preparing the cash flow statement is using indirect method or indirect format. Using indirect format, A company reports income of the entity and adjusts it for those items that are necessary to get the net cash. Okay, this is the format of cash flow statement. So there are two formats here. So the top box is the direct method. You can see that if a company uses direct method to prepare cash flow statement, it is very straightforward. The cash flow from operating activities is shown as cash in and cash out. In this example, there is a cash received from customers, cash paid for merchandise, cash paid for wages and other operating expenses, cash paid for interest, cash paid for taxes. So, and then you will get net cash provided by operating activities. So, this is direct method, very straightforward, cash in and cash out. But if a company uses indirect method, then the thing is a bit complex. Okay, so if a company uses indirect method, then the company has to show the net income, and then the company has to show adjustments. Adjustments done to reconcile income to net cash provided by operating activities. There's adjustment here, so it is quite complex. Okay, this is example of statement of cash flow using indirect method. This is the full example. How to prepare the income and the cash flow statement using indirect method. See here, so the first thing that you have to show in a statement of cash flow is you have to show the cash flows from operating activities. Cash flows means cash in and cash out, and then you calculate the total for the cash flow from operating activities. After that, you have to show the cash flow from investing activities. There are cash in and cash out related to investing activities, and then you calculate the total. The next thing is you have to show the cash flows from financing activities. Cash in and cash out related to the financing activities. After that, you calculate the net cash for the financing activities, and then you calculate the net increase or decrease in cash. You add all the net cash from operating activity, and the net cash from the investing activity, and the net cash from the financing activity. You will get the figure for net increase or decrease in cash. In this example, the net increase, there is a net increase in cash, 5,000. And then you have to show the cash balance at the you have to show the beginning balance of cash for the accounting period. You can get that beginning balance of cash figure from the balance sheet, and then you have to show the ending balance of cash for the year. Also can be found in the balance sheet of a company. So here you can see the number is correct. The net increase in cash is 5,000. Beginning balance of cash is 12,000. So the ending balance of cash is 17,000. You have to remember the format of this cash flow statement. Okay, this is the summary for this topic. The first one is the statement of cash flows can be presented using either the direct method or indirect method, where the difference between the two exists only in the operating activities. In the way you present the cash flows related to operating activities. Entities are allowed to choose between the direct method and indirect method. However, MFRS 107 recommends direct method, while most entities prefer indirect method. I don't know why other companies prefer to use indirect method. Because direct method is easier to understand, isn't it? Because you can see clearly what is the items related to cash in and items related to cash out. Activities within any businesses are identified to be within three groups, namely operating activities, investing activities, and financing activities. The presentation of information on cash flows by activity groups enables users to understand where most cash flows in from and where cash flows out to. Consequently, users are given the opportunity to analyze how well entities manage their cash within their activities. So statement of cash flows is very important. Like I said earlier, if you open a financial statement, you will see income statement, and then balance sheet, and then statement of equity. These three statements are prepared using accrual basis. You know what had happened in the business, but you do not know about the cash. Is the business has sufficient cash? So when you see the statement of cash flow, you can see the cash in and cash out, and you will see whether the company has sufficient cash to survive, or the company has more than sufficient cash, and the company can use the cash to invest in the future. So statement of cash flow makes the financial statement a complete report for accounting user. Accounting users see the financial statement as a complete report, and hopefully can see and can understand the thing that is related to a company, and then can make a good decision and a good economic decision. Okay, thank you very much. This is the end of lecture for this topic. You will see sample questions related to cash flow statement later. I will prepare another video to show the way to prepare the statement of cash flow. You can communicate with me in the comment section.